Have you ever sat staring at the screen with tangled indicators running back and forth, green and red flashing like hypnosis, and asked yourself, am I really trading or am I just chasing a bunch of soulless numbers? I have fallen into that feeling many times. Sleepless nights glued to the chart from stock, RSI, MACD to Ichimoku, Fibo. But in the end, my account still bled. At that moment, I realized what killed me was not the lack of indicators, but psychology itself. And from then on, I have always been haunted by the question, indicators and trading psychology, which one is more important? I will tell the story from my own journey, with all the shocks, the FOMO moments, the account blow-ups, and even the moments of realization. Welcome to Day Trader, where we expose the raw truth behind the waves of the financial market. Here, we don't just talk about profits and losses, we dissect the psychology, mindset, and mental toughness of a real trader. 1. My beginning with indicators. When I first stepped into the market, I felt like a child lost in a technical forest full of obscure paths. At that time, I didn't know what I was searching for. I just knew that I had to follow what the people before me had said. One person would tell me, use RSI, it's really accurate. Another would say, MACD is the holy grail, just follow it and you'll be right. Then someone in the group said, without Fibo, you're blind. All these pieces of advice only made me more confused, but I couldn't help but try them out. So I started adding all kinds of indicators onto my chart, with lines running every which way, overlapping each other, turning the screen into a colorful matrix that, without experience, would seem like an abstract painting. I started to believe in those pieces of advice, thinking that the more indicators, the more signals, the more accurate the predictions would be. I thought that I could predict every market movement if I knew how to read the numbers and lines. And so, I entered the game with full confidence because I had all the tools, all the information, all the theories. But the reality was completely different. One day, I saw that RSI was signaling oversold conditions, and I thought this was a great buying opportunity. I placed a buy order, hoping the price would bounce back. But instead of rising, the price continued to drop. Then I saw MACD crossing upwards, and I thought, here it is, the next buy signal, so I jumped in again. And then the market suddenly reversed. The price kept falling. In my mind, one question kept repeating, why do I keep failing like this? It was always the same. I kept following the indicators without fully understanding what they were telling me. RSI signaled oversold conditions, and I thought the price would rise, but the market reacted the opposite way. MECD showed divergence. I placed a trade, but it ended in a loss. I began to feel doubtful and exhausted. Was it that the market always tricked the indicators? Were these signals just a game of the market to make me lose my confidence? That's when I realized, relying solely on indicators without understanding what they were really reflecting was like blindly walking down a path full of stones. Those signals aren't always accurate because they are just tools, indirect reflections of the market. They cannot make decisions for you, and sometimes they're just illusions that make you believe you can control everything when in fact you can't. Gradually, I came to understand that the losses weren't because the indicators were wrong, but because I didn't understand how to use them properly. I didn't understand the market, and I didn't understand myself. 2. The truth about indicators. After many years, looking back at my failures, I realized something important. Indicators aren't wrong. They are simply tools, reflections of price, lagging behind reality. When I entered a trade based on an indicator, I wasn't seeing the future. I was just looking at the past, what had already happened in the market. Indicators aren't magic. They aren't gods that can lead me to victory. They are simply a compass in my hands. Back then, I thought that indicators would give me a definite answer, a clear signal. Buy now. Sell now. Follow this, and you'll win. But the truth is, there are no absolute answers in this market. Indicators are like mirrors reflecting what has happened before, and they don't decide where I'll go or what I'll do. I look into the indicator and see the image of rising or falling prices, but the mirror doesn't tell me whether I'm on the right path. An indicator can't make decisions for me, just like a mirror can't decide who is reflected in it. The real problem is with me, not the indicators. I had expected these tools to lead me with certainty, but I didn't realize they were just clues, signals created from past data. Indicators can't reflect the entire picture of the market. They only show me a small part, a perspective of it. I trusted them too much, as if they could replace my reasoning and emotions. But the reality was different. It was me and my psychology that made the difference. Indicators could give me direction, but whether I would follow it, whether I would have the patience to wait for the result, was a different story. When I put too much faith in the signals from indicators, I overlooked the most important element in trading: emotional control, patience, and discipline. The truth is, during all those failures, I didn't just lose because I didn't understand the indicators. I lost because I couldn't control my emotions when facing them. Indicators won't help me if I'm not willing to face the truth of the market, if I don't know how to be patient and control greed, fear, or anxiety in my mind. Therefore, I came to understand that indicators are just tools. They cannot decide success or failure. The final decision is how I use them and how I face the decisions I make. 3. The shock from trading psychology. There's one time I remember so clearly that every detail of that moment is still deeply engraved in my mind. At that time, Bitcoin was fluctuating around $30,000, and the signals from the indicators couldn't be clearer. RSI signaled overbought conditions, MACD was about to cross down, and everything on the chart indicated that the market might fall. This seemed like the perfect time to short. I was confident in my analysis, trusted what the indicators were telling me. The feeling of victory seemed so close. With that confidence, I entered the trade, but within just a few minutes, the market left me stunned. The price shot up to $50,000, a leap I hadn't anticipated. Without thinking, I panicked and feared the price would continue to rise and I'd incur heavy losses, so I immediately closed the trade, even though I'd only lost a small amount. But inside, I was still full of anxiety. I thought, at least I saved a little bit, but who knows what would have happened if I let it continue. A few hours later, something strange happened. The market moved exactly as the indicators had predicted. The price dropped sharply, just as RSI and MACD had foreseen. If I had been patient, if I had kept the trade open, I could have made a substantial profit. But because of panic, because my emotions overwhelmed my reason, I missed the big opportunity. From that, I learned an important lesson. The problem wasn't the indicators. It wasn't that the indicators were wrong, but that I couldn't control my emotions. I didn't lose because of the market. I lost because I didn't trust my plan, didn't stay calm and patient. During that time, weak psychology led me to make wrong decisions, and negative emotions like fear, greed, and insecurity affected my trading results. The lesson I learned from that shock is this: in trading, you can have good strategies, you can have strong indicators, but if you can't control your psychology, if you can't stay calm in difficult moments, all of it becomes meaningless. Indicators are tools, but it's psychology that determines success or failure. 4. When psychology overpowers indicators. Every trader has experienced the feeling of FOMO, fear of missing out, and I am no exception. This feeling is so powerful, like a wave pulling you away, causing you to lose all rationality. I still vividly remember times when I saw prices soaring, quickly and forcefully, like a tsunami, and I thought to myself, if I don't jump in now, I will miss a golden opportunity that no one would want to miss. So, I rushed in to buy, even though I knew I shouldn't, even though I had clearly drawn trend lines, even though I had calculated stop-loss levels. The fear of missing out was so intense that I forgot everything I had learned, all the plans I had prepared. And then, there were also times when I saw bad news, information I knew would harm the market, and in panic, I sold out. I didn't sell based on analysis, but out of fear. My psychology had completely taken over. In those moments, despite having all the indicators, all the analysis tools, my mind was no longer clear enough to read them. RSI might signal overbought conditions, MACD might show divergence, but at that time, I couldn't let them make decisions for me. The emotions inside me, greed, fear, anxiety, had completely taken over all my thoughts, and it was my weak psychology that overshadowed everything. Trading psychology is like a wild beast in your head, always waiting to break free and ruin every plan you've made. If you can't tame it, if you can't control your emotions, it will lead you to make foolish decisions. I remember confidently drawing a perfect trend line, setting clear stop losses, but when the price neared my stop loss, I thought there might be a reversal. I'll just let it go a little further. I moved the stop loss further away, hoping the price would come back. And the result? I lost everything. My account evaporated because I couldn't control myself. So I realized the indicators aren't wrong, but when your psychology is overpowered, they won't work. All the plans and strategies you've laid out will become meaningless if you can't maintain your psychology throughout the trading process. 5. Balancing indicators and psychology. After many valuable lessons, wins and losses, and psychological shocks, I realized an important thing. Indicators are necessary, but psychology is the key determinant. Initially, I thought I could use any indicator, from RSI, MACD, Bollinger Bands, to simple technical analysis tools like price action, and I would win. But I was wrong. Indicators can help you identify trends, help you make decisions, but if you can't manage your emotions, if you can't stay calm when the market goes against your expectations, those indicators will become useless. I used to be a trader who believed that having enough tools, enough indicators, would give me control over the market. I naively thought that the signals from the indicators would always be right. But then, when the market didn't follow my predictions, I became confused and started acting uncontrollably. There were times when I even went against the very signals I had drawn because I was afraid of missing an opportunity. And that's when I lost. What I learned from those failures is, you can have all the best analysis tools, but if your psychology isn't stable, you won't be able to use them effectively. Trading psychology isn't about not being afraid or not being greedy, because emotions are a natural part of being human. We can't eliminate them entirely. You can't not be afraid. You can't not feel anxious when the market moves against you. The important thing is learning to recognize and accept your emotions, observing them without letting them control your decisions. When you learn to accept the existence of emotions, you won't let them distract you. You won't be afraid when the price moves against your trade, and you won't feel greedy when the market moves in your favor. You'll gradually build the ability to remain calm in the most stressful situations. And from that, you'll become a disciplined trader, knowing when to enter a trade and when to stop. I realized that managing psychology in trading is like practicing a sport. You can't completely eliminate emotions, but you can train yourself to control them so that when facing difficult situations, you can stay calm and make the right decision. Indicators are tools, but psychology is the deciding factor that helps you become a successful trader. 6. The eternal debate. Which is more important? The eternal debate among traders. Which is more important, indicators or psychology? Every time I hear this question, I am reminded of my early days in the market. Some people say indicators are everything because without tools, how can you read the market? They believe that analysis tools are what help them predict every market move. While others claim psychology is what matters because no matter how powerful the tools are, if the mind isn't strong, everything is useless. And truly, I've walked both paths. When I first started, I, like many others, believed that as long as I had the right tools, the right indicators, all my decisions would be correct. I tried to catch every signal on the chart, from RSI, MACD, Bollinger Bands, to Fibonacci, Ichimoku. I felt like I had all the most powerful tools to beat the market. But after some time, when I looked back, I realized there was one crucial thing I had missed: psychology. I didn't lose because I lacked tools, but because I couldn't control my emotions. I once entered a trade when I was afraid of missing an opportunity, and I also exited a trade too early because I panicked when I saw the market moving against me. I realized that in those moments, no matter how sharp the indicators were, they couldn't help me because my psychology had gotten out of control. So, what's more important? After many years of experience, I've come to a conclusion. I choose to stand in the middle. I believe that indicators are like a knife, and psychology is the hand. A sharp knife is useless if the hand holding it is shaking. But a calm hand, even holding a dull knife, can still prepare a great meal. This means that both indicators and psychology are indispensable. Indicators help you identify trends and entry points, but psychology helps you make the right decision, wait patiently, and stay calm when the market goes against you. You can have all the analysis tools, but if you can't control your emotions, you won't be able to apply them effectively. Therefore, Treat both indicators and psychology as two critical factors that you must master in order to succeed in this volatile market. The final thought. If you ask me, my answer is simple. Indicators are the foundation, but psychology is the soul. In trading, you can have powerful technical analysis tools, sophisticated indicators, but without a solid mindset, you won't be able to use them effectively. Indicators help you identify trends, give you signals, but it's your mindset that is the key factor in helping you remain patient, stick to your plan, and not let emotions influence your decisions. You need both, but if you have to choose one, choose psychology. Because a trader with a strong mindset, even with the simplest tools, can still survive and thrive in this volatile market. You can have a pile of indicators, but if you can't control your emotions, you'll easily make mistakes that no tool can save you from. Thank you for listening to my story and insights. If you found this content valuable, don't hesitate to hit the subscribe button, share it with your friends who are pursuing the path of trading so we can all learn and grow together. Even though this road is full of challenges, it is also full of opportunities. See you in the next video.